There are many different classifications of trends in technical analysis. It's useful to examine the more common ones, since such an understanding will give us perspective on the significance of specific technical developments. The three most widely followed trends are primary, intermediate, and short-term. Whenever we talk of a specific category of trend lasting for such and such a time or such and such a period, please remember that the description is offered as a rough, approximate guide, encompassing most, but not all trends of that particular type.
Basically, a trend is a period in which a price moves in an irregular but persistent direction. This green line represents the primary trend. It's a reflection of investors' attitudes towards unfolding fundamentals as the business cycle progresses. From trough to trough, the cycle lasts for approximately 3.6 years. It follows then that rising and falling primary trends, bull and bear markets, usually have a lifespan of between 1 to 2 years. Since building up takes longer than tearing down, bull markets generally last longer than bear markets. The primary trend is operative for bonds, equities, and commodities. Primary trends also apply to currencies, but since currencies reflect investors' attitudes towards the interrelationship of two different economies, analysis of currency relationships does not neatly fit into the business cycle approach. It's unusual for prices to move in straight lines, so primary up and down trends are almost always interrupted by counter-cyclical corrections along the way. These trends are called intermediate price movements, which last anywhere from 6 weeks to as long as 9 months. Occasionally, they last even longer. And some writers even classify some intermediate price movements that take as little as 3 weeks to complete. As a rough guide, short-term trends typically last 3 to 4 weeks, sometimes shorter and often longer. They interrupt the course of the intermediate trend, just as the intermediate trend interrupts the primary price movements. Short-term trends are usually influenced by random news events and are far more difficult to identify than their intermediate or primary counterparts. It's apparent by now that the price level of any security is influenced simultaneously by several different trends. Indeed, there are many more types of trends, some longer and some shorter, than the three we've just been describing. These too have an influence on price. Whenever we're considering a specific technical event, our first objective is to understand which type of trend is being reversed. For example, if a reversal of a short-term trend has just taken place, a much smaller price movement may be expected than if the event was reversing a primary trend. Obviously, short-term traders are principally concerned with smaller price movements, but they also need to know the direction of the intermediate and primary trends. This is because these longer-term trends dominate the characteristics of near-term price action. Typically, all surprises develop in the direction of the primary trend. In a bull market, they'll be on the upside, and in a bear market, on the downside. Just think of it this way. A rising short-term trend that develops in a bull market is more likely to be much greater in magnitude than short-term downtrends, and so forth. It follows that trading losses usually happen when you're positioned in a counter-cyclical manner against the more dominant trend above it. What is true for longer-term trends is also true for intraday data. In this case, the short-term trend in the daily charts becomes the long-term trend in the intraday charts, like this. The intermediate trend lasts 3 to 12 days, and the short-term 4 to 12 hours. Summary of trends. 1. The principles of technical analysis can be applied equally to any time frame. 2. There are three main trends: short, intermediate, and primary. Intraday trends also exist. 3. These trends interact to determine day-to-day price activity. And 4. The greater the time frame, the greater the significance of any technical indicator offering a reversal signal.